Charles Leggett from the investor website London South East. I'm joined today by Dr. Martin Hall, Head of Life Sciences at Hardman Co, and he's been researching the best and worst performing life science companies of 2020. Martin is the author of the Hardman Co Healthcare Index, just published. It's available to download on the Hardman website. It is full of useful information and I highly recommend it. And he's here to share that analysis with us right now. Welcome, Martin.
Thank you, Donald.
Okay, 2020 will forever be known as the year of the pandemic. So with the benefit of hindsight, as you have, why did it become an exceptional year for investors in life sciences?
Well, life sciences, which encompasses all aspects of pharmaceuticals, biotech, medtech, and healthcare, is generally considered to have defensive qualities, but yet they also offer good growth opportunities. So whichever type of market we're operating in, investment in life sciences can do very well. And this is reflected in the long-term performance shown up by the index relative to other market indices. But the outperformance of the index in 2020 was exceptional. And this was closely linked, in my opinion, to the pandemic. And companies were involved in this in several ways, which we highlight in the note, and they include sort of diagnosis, vaccines, treatment, infection control, and medical equipment. So companies involved in those areas did do better than those that weren't.
You have the Healthcare Index. Why did you create it, and why did you do this research pretty much each year? It looks very easy, but it's 12 very dense, packed pages of information. It's a lot of hard work. Why did you do it? What's the point?
But at the end of the day, I love the sector. I mean, I like to modestly think of myself as a walking database of the pharmaceutical industry. And I do say that with reason. As you know, I have statistics going back to 1985 on the pharmaceutical industry, both drugs and the companies themselves. And I don't think that there are many analysts in the world that could produce that type of work. So I just love it. It's been my whole life. But the main function of the index is to highlight the attractions of UK life sciences investments over the long term. And I think what's been happening in the last 2 or 3 years, but particularly last year, just exemplifies the whole reason for doing it.
Can you remember several individual healthcare companies making 500% plus gains in a single year before?
I look back over 5 years, 6 years, and there's only one other incident where we had a 5-fold increase over the course of the year, and that was in 2019 with Therapeutics. Several times we get 2 to 3-fold increases, but having 5-fold, 10-fold, and in this case 25 times is truly exceptional.
It's mythical. It's what London South East investors are looking for every day of their investment lives, and suddenly it happened in 2020.
Yeah, it was a fantastic year if you're in the right stock.
Yes, which takes us very neatly on to there were 14 fallers out of 52 in the index. So what can I say? Pity those investors who were in healthcare, they were in the right place, but they still managed to lose money. Poor Shield Therapeutics, a client of yours, gets the wooden spoon, down a whacking 62% on the year. So an obvious question, why did the fallers underperform such a potentially strong market?
Well, of course, you'll be aware that not all the companies in the sector have technologies that potentially benefit from the pandemic. One obvious one is Eurogenics, which is a Hardman client, but its products are used in elective surgeries. So during the pandemic, while all the surgeons couldn't enter hospital, patients couldn't enter the hospital for risk of catching the virus, obviously surgeries were down significantly, well, massively, and in many cases, as is the case today, almost stopped 100% apart from emergencies. And so therefore their products weren't used, and that had a knock-on effect on the performance of the company. I suppose ironically, Shield does have a product with the potential to benefit from the virus because it has an iron replacement therapy which prevents, it's an oral product, whereas the gold standard is to give an intravenous iron formulation, and you must give that in hospital. So it has a product that prevents patients that need iron replacement going to hospital. But of course, there were other reasons why it's underperformed, and notably because the product, although approved, is not available on the key US market. And when that news came out that they still hadn't been able to sign an acceptable licensing deal, it underperformed. So obviously timing, because that came out in December, really affected its actual year performance in 2020.
So do you think Shield Therapeutics will yet have its day in the sun? Will it get its licensing in the US sorted out?
Well, it's got two options. It can either continue down the route that it set out to, which is to basically use partners to license the product. But of course, what it's learned over the last 18 months is that it doesn't involve rocket science, and there are many aspects of it it could do itself. And in order to get the same return, a partner would need to sell 3 times more product than Shield would be able to sell. And given it's such a specialist product, that's unlikely. So I'm sure when we come on to potentials for 2021, that Shield will probably be in there on the other side of the equation.
Very good.
The other one I sort of picked up on, and I thought for a different reason, Renuron didn't do particularly well last year. It's an incredibly capital-intensive business. And whilst there's nothing per se wrong with that, and people are happy to invest in those types of companies, it must be on the back of progress being made. And I think the problem is that for 5 years, it's just been asking for more and more money, and they're not seeing enough progress. So you've got a situation where it's burnt through about £135 million so far, and its market cap today is only about 50. So you can see it hasn't been a good investment.
Okay, which links us neatly again into the pandemic put science and its health benefits centre stage, as we've just discussed. So did life sciences with a hint of a solution for testing and vaccinations attract the easy money in 2020? But what about 2021? Can we expect a more considered, evidence-led approach to healthcare investing in 2021?
I think in answering your question, I'm just going to take you back a little bit, Don. So over the many years that I've been covering the sector, there have been big changes in the interest of the major institutions, whereas 20, 30 years ago, all of them had specialist fund managers for the sector. And whilst that's still the case today, where they do have those specialists, because of the size the funds are, they tend to only focus on the large cap or mega cap stocks, if we're being honest. And so whilst there might be interest in the institution in the sector within small cap funds, that tends to be quite limited. And of course, it's not very specialized. So they obtain their exposure today through alternative investment vehicles like venture capital groups, private equity, and specialists like Arix Bioscience and Syncona, which are quoted companies. So consequently, there's a good chance that they have missed out on the exceptional returns in 2020, and it's forcing them to rethink their strategies. And in order to get involved, they need placings to be able to make a meaningful investment that might alter and make a difference to their performance. So we had a number of raisings last year. And
let's stop you there, Martin, and actually ask the question. I was going to say that does neatly flow into lots of companies took the chance to raise funding, placings, and healthcare, as we've noted, famously takes both time and lots of capital to come good. So what did you make of all that? Talk me through placings.
Yeah, well, we always, with our group of 50 plus companies, you're always going to get some that require capital. It's a capital intensive business. So you're always going to get some each year. But last year, it really was exceptional. More than 50%, I think it's 55% of our companies need or took the opportunity to raise money. And when I actually added it up, it was a staggering in excess of £820 million, which it's quite superb that the sector was able to attract so much money. As far as the future is concerned, I mean, it will go on. It will continue. But one or two companies, let me just think. Notably, I think Avacta. I think they were able to raise more money than they hoped to, and I think that Eurogenics also raised more money than it originally wanted to. So it's set them up really quite well for the next probably 18 months to 2 years.
Now, I know that you follow Big Pharma as well as the small cap sector. So turning to Big Pharma and AstraZeneca, another of your favourites. AstraZeneca created a vaccine for Britain and the world, reputationally wonderful, but it didn't feed down to shareholders. So bluntly, why not?
Well, again, it's really important on timing. Obviously, the healthcare index is a snapshot from the 1st of January to the 31st of December. And so if you actually looked at AstraZeneca over the course of 2020, which we do highlight in the note, I mean, there was a period where it was performing superbly, as you say, on the back of its involvement in the development of a vaccine. They spoilt their copybook slightly in December when they announced the $39 billion acquisition in the United States. And of course, the market, used that as to block in some profits, but also it made it focus on, what was it doing and did it really need the cash flow? What was happening to the growth of the promised growth of its R&D pipeline? So I think it raised more questions than it answered, and the stock gave up all of its gains, and it ended up, of course, down on the year. Similarly, Glaxo was involved in vaccine development as well, but over the course of the year, it too was down. And of course, Smith & Nephew, for the reasons that I mentioned earlier on, are involved in elective surgeries as well. And so their performance has been affected. And of course, you lose 10% of sales. I suspect that will translate into something like 30% of profits down. But the market still possibly is expecting too much on the profit side.
Okay, as we get to the end of our interview, I'm going to take you through a couple of small cap losers, a couple of small cap winners. Let's start with the small cap losers, which you think will turn it around in 2021.
I do genuinely believe that you will see a big turnaround in Shield in 2021 because you take the market cap's only about £50 million today, and that's more than backed and supported by its existing deals for both Europe and in China. The market is almost pricing in that they won't get anything from the United States. And that's just simply not the case. They're definitely going to get something. It's a question of how much they get and the timing of when it comes through. So whether they continue with the partnership arrangement or do it themselves, they will get something out of the United States. And that's something I think will be quite large. It's a good potential market for them.
And give me another loser turned into winner, maybe one or two thoughts?
Again, I think Eurogenics. So they started the year desperate for money to invest to expand capacity. And the reason they needed to expand capacity was because they had so much demand for their products. Now, the pandemic has caused a temporary hiccup in that demand for obvious reasons. And so as we come out of the pandemic, then you will have the resurgence in demand coupled with the ability to actually service that demand because they're investing in more than doubling their capacity in the United States. I also think there's a third one that will probably do quite well this year. Again, I have to say it is a Hardman client, but Diurnal is well positioned. It's got a product on the market, and we're sitting here anxiously waiting for how it started in the United States from its partner. But more importantly, it is potentially going to get European approval for the product for adults. The one on the market at the moment is only for children. So the one for adults is potentially a 4 to 5 times bigger market. And that's up for European approval during the first quarter of this year.
Okay,
so if that comes through, it should do well.
That's all very interesting. And a couple of small cap winners, which will continue to outperform. I mean, I'm thinking Avacta, but what do you think?
Oh, you put the words in my mouth.
I just think that Alistair Smith is a good chap.
Well, I think Alistair A is a very good CEO, but also I particularly like the way he is able to explain what is potentially difficult technology in a very straightforward and understandable way. But what I really like about Avacta is that it's got three approaches. It's got big partners for the pandemic aspect, which of course is all add-on. It wasn't there a year ago and it is today. It is continuing to attract licensing partners for the Pharma technology. And thirdly, and this is where I always liken Avacta as being a mini, a next generation ABCAM. I think that the approach and everything is exactly the same, but the business model is somewhat different in that Avacta is also developing its own therapeutics using its Pharma technology. And it should enter the clinic with its first therapeutic in 2021. And that's usually associated with a value enhancement point.
And one more stock which did well in 2020 and you think might have prospects for 21?
It did well. It didn't sort of come out in the top 5, but it's just caught my eye over the last 6 months is EKF Diagnostics. Relatively expensive now, but if you just look, so they put out an announcement, I believe it started in September, that they'd had a really good start for the second half of the year. The stock went up. In October, they had a very good third quarter. The stock went up. In December, they had a very good fourth quarter. And now they've just said that's continued into the first quarter of 2021. Now, you like to see companies putting out that regular flow of extremely positive news. And again, leverage effect, that must translate into a much greater increase in profitability. So I think that will continue to do quite well if they can continue to benefit from the pandemic the way they have.
Dr. Martin Hall, thank you very much indeed for joining us today. I really appreciate your time. He is the head of life sciences from Hardman Co. And if you want to read Martin's Healthcare Index, it's free to download on the Hardman website. It's a very good read. Meanwhile, thank you for watching and stay safe.